They called me crazy when I said I love market crashes. They said I was insane when I told them that volatility is just money in disguise. But here I am, sitting on a six-figure portfolio that's designed to actually make more money when markets go crazy. While others panic, we profit. While they fear volatility, we feast on it. Welcome to Psycho Investor, where we don't just survive market chaos, we thrive in it. Today, I'm going to show you exactly how you build a portfolio that actually makes more money when markets get volatile. If you are new here, this is where we hunt down the insane yields and turn market fear into the pure profit. Today, we are diving deep into something that most investors run away from: volatility. Look at this screenshot right here. This is my actual portfolio during last month market panic. While everyone else was losing sleep, we are collecting massive premiums and setting up positions that would multiply our returns. Before we dive into psycho strategies, let me show you something that will completely change how you think about market volatility. Most investors see this chart and panic. This is the VIX, what I call the fear meter. When it spikes like this, most investors are panic selling. The portfolios are bleeding red and they are having sleepless nights. But look what happened to our portfolio during these exact same moments. See these spikes? Every time market fear increases, option premiums explode. During normal times, our CONY position generates about 40 to 70% yield. But when fear spikes, the yield jumps to 146.11%. We are not just collecting pennies here. This single position is generating $3,677 in annual income from a $2,516 investment. Let me show you exactly why this happens. When markets get volatile, something beautiful happens to option prices. Look at the portfolio we've built around this principle. First, option premium harvesting. While others are scared of volatility, we are harvesting it through options. Take our COIY position. That's our coin-based strategy. When crypto markets get wild and the big spikes, we are not panicking. We're collecting an 80.7% yield. That's almost $2,000 in annual income from a $2,500 position. Over $5,500 in passive income just from two positions related to one Coinbase stock. Second, leveraged amplification. Look at our TQQQ position. 80 shares might seem small, but when the Nasdaq moves, this position moves 3 times as much. We are not gambling here. We are strategically using leverage to amplify our returns when opportunities present themselves. Third, strategic position building. This is where it gets really interesting. See how we've structured our crypto exposure? We've got BITO as our foundation at 2,075 shares, generating a 56% yield. That's $25,768 in annual income. But we don't stop there. We layer on CONY for maximum yield capture during volatility spikes, plus position in MSTE and MicroStrategy for pure equity exposure. When you put these three strategies together, something magical happens. While others are praying for calm markets, we're generating almost $46,000 in annual income from $150,000 portfolio. That's over 30% yield across the entire portfolio. And it's not despite volatility, it's because of it. This isn't about gambling or taking crazy risks. We layer on our volatility capture positions, each carefully sized according to its risk profile. The result? When markets are calm, we are collecting solid yields. When volatility spikes and others panic, our yields actually increase. This is what I mean when I say volatility equals more money. We've built a portfolio that actually makes more money when markets get crazy. What makes this portfolio truly special is how we create multiple layers of exposure to our highest conviction plays. Take our crypto exposure. We've got BITO as our foundation, CONY and MSTE for maximum yield capture, plus direct position in MicroStrategy for equity exposure. When crypto volatility spikes, these positions work together to maximize our returns. We do the same thing with tech exposure. QYLD gives us broad tech market premium income, TQQQ provides triple leverage for price movements, and then we have the targeted positions like TSLE and NVDE for specific stock volatility capture. This creates multiple ways to profit from the same market movements. The real power comes from how we structure position sizes. Each position is sized not just by its yield, but by its volatility profile and correlation with other holdings. That's why our highest yield positions are kept to smaller allocations, while our foundation positions can be larger. But here's the truly psycho part. We are generating $46,000 in annual income from $150,000 portfolio. That's $3,830 hitting our account every single month. And because we've built this through careful position sizing and correlation management, we are not just hoping for these returns, we are engineering them through systematic volatility capture. But this is where it gets really psycho. Look at our leveraged positions. TQQQ at 80 shares and QQQ3 at 6 shares. Now, most financial advisors would have the heart attack seeing leveraged ETFs in a long-term portfolio. They'll tell you about decay, about how these instruments aren't meant to be held overnight. But let me show you exactly how we turn market chaos into opportunity. Look at these points where the big spike above 30. During normal times, everyone's talking about how dangerous triple leverage is. But when fear spikes and the VIX crosses 30, that's when we start our buying framework. Let me break this down with the real numbers. When the VIX crosses 30, we are looking at serious market fear. Most investors are panic selling. But this is exactly when we start scaling into positions like TQQQ or QQQ3. We are not going all in. We are starting with small position sizes, about 1% of our portfolio. Now, when the VIX pushes above 40, this is where it gets interesting. Look at historical data. These are rare events. We're talking about moments like COVID crash or 2008 financial crisis. This is when we get aggressive. Remember our TQQQ position? We've got 80 shares now, but we've built this position strategically during these high fear moments. When the VIX hits 50, this is what they call maximum fear territory. This is when we go absolutely psycho. But with this system, look at our current TQQQ position. Almost 7,000 invested in 80 shares. During these extreme fear moments, we are ready to double or even triple our position size. Why? Because historically, these VIX 50 plus events have marked significant market bottoms. But here's the key. We are not just randomly buying leverage. Look at how we've structured this in our portfolio. TQQQ at 4.31% of our total portfolio, QQQ3 at roughly 1%. Together, our leveraged exposure is carefully managed to around 5.4% of the portfolio. This isn't gambling. This is strategic position building using market fear as our own guide. And look how this plays with our other positions. While TQQQ and QQQ3 gives us that leveraged exposure to tech, we've got COILD at 19 to 20% of the portfolio, generating steady income through covered calls on the same underlying market. When volatility spikes and we are buying leveraged, QOLD option premiums are also increasing. It's a beautiful symphony of volatility capture. Here's our exact buying framework during these high VIX environments. VIX above 30, start with 0.5% portfolio allocation. Focus on quality names, QQQ3 rather than individual stock leveraged. Set limit orders 5 to 10% below market price. VIX above 40, increase allocation to 1 or 2% of portfolio. Adding to existing positions that are down most, consider adding sector-specific leverage like TSL3 for Tesla exposure. VIX above 50, prepare for maximum deployment up to 3% per position. Look for multi-decade support levels, consider using margin if you've got the stomach for it. But remember, this only works because it's part of a larger strategy. Remember our foundation positions? This gives us the stability to be aggressive with our leveraged positions when fear is highest. The real magic isn't just buying the dip. It's having the portfolio structure that lets you stay solvent while others are forced to sell. That's why we maintain positions like UILD, Main, which generating steady 10% or 4% yields. That income gives us the ammunition to be aggressive when others are fearful. Now, let's put it all together. Here's my actual volatility profiting portfolio structure. Our foundation layer makes up to 60% of the portfolio, beta, main, QILD. Moving to our amplification layer, taking up to 30% of our capital, we combine triple leverage Nasdaq 100 for leveraged tech exposure with TSL3 for maximum volatility capture, alongside our income shares ETPs that harvest premium income. The final piece is our opportunity layer, representing up to 10% of the portfolio. This includes our dry powder for extreme volatility events and strategic crash positions that can deliver massive returns when markets get truly chaotic. Now let's get to risk management, and listen up because this is crucial. We are not gamblers, we are psycho investors. That means we need position sizing that lets us sleep at night while still capturing massive returns. My volatility risk management framework starts with a strict limit on high beta positions, never exceeding 40% of the total portfolio. We maintain a cash position between 5 and 10%, keeping our powder dry to those perfect opportunities. Portfolio balance is maintained through careful correlation analysis, and we constantly adjust our position sizes based on current volatility levels. This framework lets us stay aggressive while keeping risk under control. Let's wrap this up with something that separates true psycho investors from the rest. While others pray for calm markets, we build to profit from chaos. While they fear volatility, we feast on it. And if you want to learn more about maximizing your returns through volatility, smash that subscribe button, hit the notification bell, drop a comment with your favorite volatility plays. And remember, they called us crazy for loving market crashes. Let's show them just how profitable crazy it can be.